Welcome to the Bangers Only podcast, where Tom Lydon and his band of experts make money talk exciting. Here's your host, Tom Lydon.
Welcome to the Bangers Only podcast. Life's short. We've got to keep things simple. Use your time to focus on what's most important. That's what Bangers Only is all about. I'm Tom Lydon, and joining me today is Todd Sohn, who's Senior ETF and Technical Strategist at Strategas. Todd, welcome. Hey, thanks for being with us.
My pleasure, Tom. You're a great inspiration to me, so I'm happy to join you.
Well, thank you very much for that. And let's get started. I want to dive right in because I get so many questions for you. But first, talk a little bit about Strategas. What do you do in your normal day? I mean, you guys are a macro research firm, but also you got your finger on the pulse on the ETF business and everything that's going on.
Yeah. So let's see. Strategas is as you said, macro research provider. We cater to institutions around the world, long-only managers, RIAs, pension funds, hedge funds. And we have all sorts of different research verticals: investment strategy, economics, fixed income, technical analysis, which I participate in. And then also my bread and butter, ETFs. I try to look at the markets through the lens of ETFs because they're a great temperature barometer on what's going on in the markets. They serve a dual purpose: low cost, long-term investing, and understanding where investors are moving their money, right? We can look at fund flow data every single day. Product launches help too. So I try to live in my corner and support the broader investment spectrum and get to talk to some great clients every single day of the year.
Yeah, well, you do a great job. I love getting your research, and we're going to make sure at the end, if people want to grab it, that they've got the ability to do that. Mm-hmm. So, here we are, almost halfway through the year. It's been an unbelievable up and down year. A lot's been going on. What are the markets and what are ETF flows telling you right now as we look into the summer?
Yeah, and to give some context, we came into 2025 with what I would have deemed a very aggressive stance, coming off of back-to-back 25% years on the S&P 500. It's great. People are building wealth. But when you look at flows, they were coming off of a record year last year, especially at the equity level. And so I like to measure whether it's a rolling sum over a year or just taking a pure average per day. We were doing about $3 billion per day at the start of the year. Historically aggressive. And that part of that's ETF growth, but part of it's also investors being a little too optimistic.
Yeah.
Fast forward to today, we've had this tariff-related correction. And I find it interesting that since the April 8th low, we're about 2 months off of the market low, that average inflow per day to equity ETFs has been cut in half, only about $1.5 billion. Still really strong, right? ETFs are still going to grow. But in a tactical sentiment stance, there's a lot of skepticism right now. And I think that's supportive. That's great for investors who want to be long equities.
Yeah. So do you think that investors just don't believe it? They were really scared when April turned, and there were a lot of economic things that were affecting that as well. Things bounced back when most felt that they wouldn't, and they're not leaning back in.
Yeah, I think, and there's always going to be money going into Vanguard type products, right?
Yeah.
There's a passive drip, and you and I, we invest, right? Part of my paycheck goes to ETFs, and I invest all the time. But for those who play more, say, month to month, quarter to quarter, they don't want to get back in. They're skeptical of the effects of tariffs or what any other, geopolitical risk out there is. And I just find it amazing. There's a lack of demand for equities. And if you dig a level deeper, there's a lack of demand for what I would deem risk-seeking equities like small caps and cyclical sectors.
Yeah. You mentioned small caps. Boy, I was really encouraged because I'm always cheering for the underdog. We saw a little bit of interest early in the year from small caps. They started to bounce back. The large cap bullies have beat up the small caps tremendously in the last 5 years, and it was nice for them to get a little bit of love. But It's just fizzled out too, hasn't it?
Okay, so small caps, gosh, number one, companies they don't IPO anymore, right?
Yeah.
They stay private, which is a whole other pipeline of product waiting to be deployed to investors. And if you think it's about small caps, the Russell 2000 last made a new high in November 2021. We're going on almost 4 years of basically a bear market for small cap stocks. So it's been extremely challenging. And if you're an asset allocator, you almost have to question, do I need small cap exposure? I do tend to wonder maybe if that's changing now. Like you look at flows to small cap ETFs, and those are going to be all sorts of kinds, active, passive,
Yeah.
factor based. There's been outflows. So I think investors are throwing in the towel at the wrong time on small caps.
Yeah, I mean, look, historically, as you know, small caps have outperformed large caps, but it's been terrible in
Yeah.
the last 5 years. But now, from a valuation standpoint, they're selling for 30 to 40 to 50% off uh, their their large cap brethren. And at one point in time, doesn't that pendulum need to swing?
You would think so. Unfortunately, some of the small cap indices, and I think this is a great space for active management or a factor tilt. Some of the indices in small caps are flawed. There's a lot of boom and bust biotech companies, right? Whether they get a drug approval or not. And then
Yeah.
there's a lot of regional banks which have had their struggles. You go back to March 2023, we had a regional bank blow up. And so I think that's hindered the small cap spectrum, especially relative to all these mammoth technology companies.
Yeah. So are you saying maybe there are a lot of companies that are in these small cap indices that if they had to apply again just wouldn't make the cut because their businesses just aren't what they used to be?
Yeah, yeah, and they're still small cap for a reason, right? The ones that graduate have attractive businesses, whether it's in discretionary restaurants or hotels or some sort of software that is impressive to some of the higher ups in the tech landscape. So I think that's why you're seeing all these good stocks graduate, and you're left behind with some of the stuff that causes performance problems.
Yeah. Yeah. Hey, you were talking about how people are feeling about the market sentiment. Walk through some of the things that you look at and some of the measurement tools because I find that fascinating.
Oh yeah, I mean, I love sentiment, right? It's you think about markets, there's earnings, there's dividends, and then there's sentiment to us, right? Especially when the crowd goes in one direction too far. That happened in 2020 and 2021, and to extent earlier this year. Or on the opposite side of that, if folks get too negative, like in October 2022, that's how markets tend to turn. And so I work off of ETF flows every single day because I think there's some really great information seeing how investors are positioning themselves, particularly when you go down to those categories. We also use the options market. I want to know how investors are buying or selling protection, right? Are options data skewed to the upside for calls? Are they skewed to the downside for puts? We look at volatility, the volatility curve for the VIX. Whenever there's a panic, the VIX curve inverts, and that's usually a great sign to actually buy stocks. And then we also use some investor surveys, right? Those are more of what people are saying rather than doing. Um, and along with that, I get to travel around the country a lot. So, what are our clients saying in their meetings? Are they
Sure.
lukewarm on stocks? So, I put this all together and try to get a sense of okay, everyone's very pessimistic on the market right now, which, if all goes well, should mean higher stock prices.
Right, right. I mean, and one of the classic surveys is the AAII bull bear ratio. We know, I mean, just months ago, it was kind of at historic bear levels, and that's bounced back a little bit. What else are you seeing? What are those sentiment indicators are really important that you see right now?
So, the survey data is still very pessimistic, right? AAII barely more bulls than bears, right? They
Yeah.
don't believe it. And that goes for the other surveys we look at too. Our clients are very reluctant to chase. So if when you look at the top of our category inflows, it's been led by Treasury bill ETFs and short duration fixed income ETFs. And I'm very much a fan of that. That reflects that skepticism and this unloved type of equity market. When those are populating the top of the workbook, it's being used by some of the tactical traders to find protection. They don't want to embrace the equity rally. So I think when you add all this up, along with the outflows from financials, cyclicals, small caps, paints a very supportive picture for stocks into the second half of the year.
Okay, so let's talk about credit and duration. A year ago, if you were surveying advisors, most felt that there would be more rate cuts than have actually happened. Number
Yeah.
one, and also we're coming off of 20-year highs in rates. We are seeing better inflationary numbers. I think still there's evidence that we might see a cut or maybe two between now and the end of the year. But people are still getting paid for having money in money market funds with $7
Yep.
trillion in money market funds. Why take the risk? With all that and what you're seeing in flows, what's jumping out at you on the fixed income side?
So this is where ETFs are a wonderful solution because the fixed income ETF market has exploded in the last 4 to 5 years, right? You go back, the Fed purchased corporate bond ETFs during the COVID collapse, and that kind of lended credence to fixed income ETFs. And so now you've seen a product explosion. I think of companies like Bond Blocks and FM Investments who are now saying you can buy the treasury curve by specific duration. I don't need to buy just a 1 to 3 or 3 to 7 year ETF. I can get super precise. And so I say this because we are about 9 months into the cutting cycle. The first rate cut was September 18th, 2024. Long duration is down since then. Long duration treasuries are down. Long duration corporates are down. This is extremely rare. We are in a very different scenario than most investors have ever lived through. So I feel strongly that take that long duration allocation, keep it down the curve, right? Or put it in some other strategies, put it in managed futures if you wanted to. But you can just sit in cash, get a very similar yield than you would on a long duration 10-year bond ETF with far less volatility too. It's so much an easier ride. It's so much easier to stomach,
Yeah.
which is extremely important. The one other item is in high yield. High yield's been great, although I wonder if we're at this point in the cycle where you're going to start to see some disparity in returns. So since we had that little earthquake in April, you're starting to see high yield energy kind of lag the other space. From again, I use the Bond Blocks ETFs here for their high yield sector funds. So I am keeping in mind of that. But there's so much solutions out there. It's wonderful.
Well, that's the point. I mean, today, advisors, investors have so many more tools. Is it too many to choose from? Or, especially
Mm.
those that are students of the market like you are, they can be really precise as far as exactly what they're looking for.
Yeah. It's a far different market today. I think a lot of issuers realized, there's a lot of white space here.
Yeah.
And I can mix and match durations. I can ladder things now much more effectively. I can get tips on different durations. And so it's okay if long duration's down. I just think investors, especially longer term asset allocators, need to understand in that 40%, if they're doing a 60-40 model, consider the long duration part maybe needs to be adjusted now. We need to tweak that.
Sure. So, but one overlying theme is the demand for income, the demand for yield isn't going away. And I think most advisors are kind of feeling at one point in time they're going to be a little bit more challenged if we actually do see some rate cuts, right?
Oh, totally.
Yeah.
People love income, whether it's through fixed income instruments or equity derivative instruments now. You can get income in ETFs through a weekly frequency, a monthly frequency, a quarterly frequency. And of course, the pushback would be, what's your tax bill going to be, right, with some of
Yeah.
this income? But in this world today where, I live in New York City, coffee's still expensive here. Groceries are still expensive relative to a few years ago. So if I'm getting that income generation and maybe a little bit of equity return on that too, that's a really hard proposition to beat.
Yeah, you're kind of touching on an area, that middle ground between equities and
Yeah.
and bonds, where buy right strategies, options overlay strategies, that market is just exploded. The number of ETFs in that space, the pure assets in the space is actually bigger than the crypto ETF marketplace. And again, for full disclosure, I'm a partner at Neos ETFs that plays 100% in that area. But it's just been amazing to see not only the people that are jumping in with products, but also the adoption from advisors and institutions, because
Yeah.
the yields, as you say, are much more attractive, and if you can get that tax efficiency as well, it's good stuff.
Yeah, the tax. So I guess the two items I would take away from this are, if you're looking at one of these income funds, it's almost like smart beta and factor funds a decade ago. Know what the methodology is. What kind of income are you generating? Is it return of capital? How tax efficient is it and whatnot? And also understand how they are generating that income. What kind of options are they using? Are they, writing calls and puts? Is it going both ways? I think that's extremely, extremely important. And as great as crypto has been as a category, something is popular and hot in the ETF world when all sorts of issuers are piling into that space.
Yeah, yeah. And it's worth doing the work. It takes a little bit more from an education standpoint, but the
Mhm.
benefits are there. And then when you learn, it's easy after you make an allocation to explain it to your clients, and your clients appreciate it. Anyway,
Yeah.
moving on, because we want to cram through a few other areas. International, Todd, man, same thing like small caps. They took off at the beginning of the year, had a bit of a correction, but they've bounced back tremendously. I mean, you look at Europe, for example, Vanguard's Europe ETF, what is it, VGK, up over
Yep.
22% as we talk.
International is back.
Yeah.
It's contributing to portfolios again. I think diversification really matters again, especially in a mega cap growth world. Last year it was Japan. Japan hit its new all-time high since 1989, and now you have Europe. So developed international is working, and the important part is when you buy international, Europe and Japan, you're getting a lot more industrial exposure there than you would in the US, and far less tech exposure. So it's a really nice balance for a portfolio. So I would highly recommend, and of course, maybe they're overbought in the short term. That's okay. I would highly recommend looking at what your international exposure is. It doesn't mean you have to go overweight US. That's always hard to beat that home country bias. But at least increase the dosage, right?
Yeah, yeah, and I think your research also shows that those areas of the market that have rebounded, it's back to the mega caps. It's back to the
Yeah.
mag. You know, it's amazing how all the resiliency in that thin slice of the market has come back tremendously. But what we find ourselves, if we're participating there, we're not very diversified, and this is an area of the market that also has great value. I mean, you're
Yeah.
getting, again, 30, 40, 50% off from a valuation standpoint, and as you point out, a diversification standpoint from a sector area.
Yeah, I think the diversification part is really important.
Yeah,
And big tech has rewarded all of us. There's no doubt about that. The
yeah,
one thing that bothers me at night is saying, okay, well, if I own large cap blend and large cap growth and maybe a tech or thematic fund involved in there, I own a lot of those similar stocks.
yeah,
That's the one thing that bothers me a little bit as much as it's benefited all of us.
yeah. Great points. Okay, emerging markets, China.
Oof.
What's going on there? It doesn't seem that they're enjoying the rebound as much.
This is one of my favorite stats is that over the last 32 and a half years, the MSCI China index has annualized at 1% per year. You've basically made no money there despite all of the attention and the saber rattling and the growth stories coming out of that region. And it's really hurt EM as an asset class. And so I think if you want emerging market exposure for the long run, I think you have to play it actively. Find one of those active managers who can go into these individual countries and find the best of those stocks.
Yeah.
Perhaps some of the report cards out there may say differently, but I think the EM benchmark has just been so skewed by Chinese equities that it's created a problem.
No, you're right. And we're going to talk a little bit more active in a minute. As we're talking about maybe ugly areas, talk a little bit about some of those weaker sectors like energy and healthcare.
So every once in a while, we like to publish on stuff that's been so bad that maybe it perks up our client interests because they're always looking for the next big move. And so starting with just flows, over the last, call it year, 2 years, the most outflows at a sector level have been from healthcare and energy. Energy, what I find very interesting is that it has erased all the inflows it took in, and this is across all the energy ETFs, Spiders, Vanguard, Fidelity. The money it took in during the inflation wave a few years ago have all left now. So maybe, a little contrarian idea there, but it's still a lot of structural headwinds because oil has not been working. And then healthcare has seen an exodus of outflows, and healthcare's performance relative to the S&P is basically in its bottom percentile over the last 50 years of data. So it's hard to get much worse in how bad healthcare has been. Of course, there's a waiting game involved. Like, okay, when is it actually going to work? But I just think if you're looking for something that's not mega cap growth, hasn't worked in ages, that's where you would start.
And back to your point earlier about picking the right companies, maybe active can help there.
Yeah.
It's amazing to see how, just 10 years ago, you looked at the weightings of energy in the S&P 500. You point this out in your research, and what it looks like today, it's night and day.
Oh, yeah. Yeah. I always find it interesting that anytime a sector doubles its weight in the S&P 500, no matter how big or small, whether it's 2 to 5 or 12 to 30 like tech did,
Yeah.
it usually spends the next 2 or 3 years just treading water to giving that back. Because you think about a car, right? You go 0 to 60 on a pedestrian road, you're going to have to, cool the engine off. And I think that's what happened with energy here. It had such a massive run during the COVID inflation era. And now there's much more structural issues. What I do
Yeah.
feel strongly about energy, though, is playing it thematically, right? So nuclear, forget the traditional E&P stuff, right? Maybe that'll come back at some point, but nuclear power for AI, that the thematic energy idea, I think makes sense.
Yeah. Great points. Okay. Let's talk about gold and Bitcoin. Gold has had a really nice run here, but it really hasn't shined while being in the shadow of Bitcoin.
Yeah.
What can you share?
So there's no doubt crypto's been a success. I think gold's one of the best trends globally. Do I feel like it got a little overcooked in the near term, just in the terms of the market perspective? Yes. And you saw some flow. All of a sudden, gold hits a 5,000-year high, call it last month, 2 months ago. And I saw a wave of flows go to all the gold ETFs out there, which I thought was interesting because they were very much agnostic for much of the ride up. So when I see that, it says, okay, people are catching on to this. Maybe we're getting a little too aggressive in the near term. But it's paused very nicely. I'm okay with that. And meanwhile, crypto is also working. So I feel like you can have both in a portfolio. The question is how much. I think that depends on the person. But they're both diversifiers here, and they come with their different levels of volatility.
Yeah.
So
I like
I'm a
that.
fan. Yeah,
I think that, I mean, look, you don't have to choose between the vanilla ice cream and the chocolate. You can have a scoop of both,
get the
right?
score. Yeah, I think that, and you're seeing solutions like that come out in the ETF world, turn stacking, right, stuff like that. And I think I think issuers are going to get more and more creative of mixing and matching those flavors.
Okay, so speaking of creative, these single stock ETFs have just exploded. Is this sustainable? I mean, is there enough? There's so many choices. There's so many players in the space. Are there enough flows? And what will this look like in 3 years?
Is there enough flows? Part of me thinks no. Okay. When you look at the assets, most of them are in the Nvidia,
Yeah,
Tesla, Coinbase, right? And then there's a lot of stuff that's just kind of treading water. I also find it interesting that since these funds have been around over the last, so they're almost 3 years old, you're getting smaller and smaller on the underlying. So we started with the big boys, Tesla, Apple, Meta, Amazon, and now we're getting into Rocket Labs, Reddit, Snowflake, really smaller names, much more volatile names. Will those take in enough flows to keep the products open? I don't know. And there's a lot of issuers now here. There's a good, and by a lot, I mean a good 5 or 6, right?
yeah,
So it's going to be, I guess, here's my question. If I have 3 different Tesla levered ETFs to pick from, or 3 different, whatever, MicroStrategy ETFs to pick from, how do I know which one to pick if they're all, let's just say they're all trading similarly, they all have similar asset levels? I'm very curious about how retail, I'm doing quotes there, decides which one to play in. You know what I mean? If I go on Reddit and they're all saying, all right, we're going to buy the TSL, whatever, from issuer, whoever, I don't know, rather than naming issuers, how does that get decided? That's what I'm very curious in, the behavioral aspect of that.
well, that's it. And I mean, you could dive in and you could put the pros and cons in each one of them for
Yeah.
sure. However, but if somebody sees an ad in the paper or a digital ad online, or they see somebody on TV, I mean, that's what the game's all about.
Yeah.
I mean, we are in a marketing world in this ETF space, and it's amazing. You can look into certain asset classes or sectors, and some of those that are winning at the top of the league table aren't necessarily the best in the group, right?
Yeah. Yeah. It's all about the marketing, the operational efficiency. So, but I have a feeling there's going to be a lot of these that probably don't remain open over the course of time just because they're the wrong stocks. And then you'll see some cult stocks all of a sudden come out of nowhere and they'll have leverage on them soon. Um, I do feel confident that the usage rate of these products, though, is going to continue to climb, right? They're only going to be 1% of the ETF industry, but
Yeah.
their volume will keep increasing because people want to express conviction.
It's fun to watch. It really is.
It
And they work. That's the bottom line. They work. So speaking of fun to watch, at the beginning you talked about how you love the ETF business, what it stands for, what it was built on. I mean, low cost, tax efficient, diversified, passive, major
Yep.
index representation. But boy, now it's a whole new deal, especially as most or pretty much all of the major indexes, that land grab is over. If you're not
Correct.
in
Yep.
that space, you can't get into it now, and the only way you can get in is versus active. So, what does that mean today? Is there still more room for active managers?
Absolutely. Um, I think this is only just starting because there's been $4 trillion out of actively managed equity mutual funds in the last 25 years. If you are running an active fund business, you have to stem that, right? And there's a couple that have been able to. That's okay. But generally speaking, you got to go where the money's going, and they're all going to ETFs. And I suspect you'll see all sorts of different strategies. You can bring the star manager in for an active strategy, but now also we were talking about income before. You're seeing all these great option strategies that were really not available to the common person for years, and that can bring a differentiated aspect to your portfolio in equities. And then fixed income is an entirely different animal, and whatever other asset classes are going on there. So
Oh yeah, you've yeah, got private credit, private
yeah,
equity that's coming, and then everyone's on the edge of their seats about this ETF share class and whether the SEC is going to grant permission. You've got over
yeah.
70 firms that are filing for that, and what does that mean to the mutual fund business if in fact that happens?
I suspect it'll hasten a lot of the taxable taxable account outflows, right? They still have 401k and defined contribution plans
Yeah,
that they'll sit there. But it'll hasten the outflows. For me, I'm just worried about how many tickers we're going to have to keep track of. Between that and single stocks, we're going to run out of tickers, and I think we need to make a number system or something,
yeah.
kind of like the X at the end of mutual funds. Maybe we need something like that.
Yeah,
Um,
it's almost like Wordle. They're running out of Wordle words.
yeah,
We're gonna have to start all over again.
yeah. I mean, Tesla has 14 different derivative type tickers. I think we're going to run out of those letters.
Yeah.
But the share class thing's going to be great. I'm not jealous of anyone in the operational plumbing of this. Admittedly, I'm on the research side, so I don't have to deal with that. But I'm watching it closely.
Okay. So there's also probably a need to weed. We need to weed ourselves out a bit. We see that happening on the mutual fund side. Is it starting to happen on the ETF side?
It's tough. You get closures. There's some
Yeah.
closures every month, but it's being so outpaced by the launches.
Yeah.
I mean, they were launching, and especially because of conversions, 351 conversions, SMA type conversions, right? You're getting all these random RAs out there who have been sitting on gains for years, and they're just saying, we'll open up the ETF to the world. I don't think you're going to get riffraff in there who are going to mess up the fund and all that stuff. And so they're launching all these new ETFs. That's another added supplement to how many launches we're seeing. So I do think some issuers probably should look at their lineups and maybe call some of the excess that are just dead weight. Um, there's probably a lot of thematic funds that may not be around in a couple of years because there's just too much supply there for a limited amount of dollars. But I suspect over time that ratio is just going to continue to climb between launchers and closers.
So Todd, is the ETF business in good shape the way you look at it? You've been at this for a while. Do you feel good about the way it's set up, the way it's running? Does it work well for the average investor? Is the average advisor in good shape? If you were the king of ETFs, are there any major changes that you would make at this point?
I think everything is in wonderful shape. You still have 4,200 solutions out there, of which you can get total equity market exposure for basically nothing. Yes, there are some fun, volatile strategies out there that, yeah, they come with a label. You want to know what you're doing if you're going to buy those. Um, Other than that, you can continue to build wealth in the long run using ETFs from all sorts of asset classes. This is about access to things that we did not have 10, 20, 30 years ago. So I think things are in great shape. And if I had to change one thing, I think a ticker system is going to be needed at some point for all the single stock and the mutual fund share class stuff that's coming down the pipeline.
Are we
But
going to
other
have to
than
go to
that,
5 letters?
We might have to my dismay, because 3 and 4 was nice, but I think 5 might have to,
Yeah, yeah.
But everything else is in great shape. You have so many choices of how to invest now, and tax efficiently too, for the most part, that it's hard to say there's a problem here. And the flows show that too. The structural flows show that. And ETFs they're breaking records every year.
Excellent. Well, Doctor, we appreciate the good report. If people wanted to follow you, talk about Strategas, how can they maybe get your research,
Yeah.
that type of thing. So give us, social, that type of thing.
Feel free to reach out to me. LinkedIn, Todd Sohn, Sohn. I'm on X, Todd_Sohn. You can email me, tsohn@strategasrp.com. It's a mouthful, but please reach out. I'm always happy to help and discuss how we can help you and your clients, or if you just want to talk markets, ETFs, any of that stuff. I'm happy to be a resource.
Awesome. Todd, thank you. This has been perfect. Really great seeing you. Hope to see you this summer, and best to you and your family.
Thank you. You too, Tom. I very much appreciate the time.
The opinions expressed in this podcast are for informational purposes only and are not intended to provide specific investment advice. Any past performance discussed during this program is no guarantee of future results.